Everybody told you gold was a safe place to hide, and then the missiles started flying, and gold dropped 20%. I want to sit with that for a second, because I think it's the most instructive thing that's happened to investors in years, and almost nobody is drawing the right lesson from it. The wrong lesson, and I hear this everywhere, is that gold is broken, gold is manipulated, gold is dead. The right lesson is something much simpler and much older, and once you understand it, you're going to look at your portfolio differently for the rest of your life. My name's Peter, and I spent a long time running money for other people before I decided I'd rather talk to regular people about it instead. And what I learned managing a fund is that the gap between what Wall Street understands and what most people sitting at home understand is not a gap in intelligence, it's a gap in pattern recognition. The guys in the big buildings have just seen this movie before, and today I want to show you the movie. So let's start with the part that's making people crazy right now. You've got conflict breaking out in the Middle East, you've got oil prices spiking, you've got headlines screaming about World War III every other Tuesday, and gold, which is supposed to be the thing you hold when the world falls apart. Gold goes down, not a little, a lot. And people are furious. They feel lied to, they feel like they bought the insurance policy and then the insurance company showed up during the flood to tell them the fine print excluded water damage. But here's what actually happened, and I'm going to explain it the way my old fishing buddy Ray used to explain things to me, slowly, with an analogy, until it clicks. Imagine you've got two places to put your money. One is a savings account at the bank paying you 5% a year, guaranteed, rain or shine. The other is a bar of gold sitting in your garage that pays you nothing, ever, but might be worth more someday. Now the world catches fire, your neighbor is nervous, he wants safety, he wants certainty. Does he pick the 5% guaranteed account? Or the shiny bar in your garage that might go up, might go down, and doesn't send you a check either way? He picks the savings account every time. And that's roughly what happens in the bond market, which is just a fancy word for the government savings account. When a crisis hits, scared money around the world pours into U.S. government debt because it pays interest and it feels safe. And when that happens, a couple of things occur almost automatically. Interest rates go up because everyone wants in and the government can offer better terms. And the U.S. dollar gets stronger because to buy those government bonds, you first have to own dollars. So everyone's selling their euros and yen and whatever else to get dollars. And gold, which is priced in dollars, looks more expensive to foreigners when the dollar is strong, so they buy less of it. Meanwhile, the institutions that loaded up on gold at $2,000 an ounce and made a fortune saw a chance to lock in profits and they took it. So you get three things hitting gold at the exact same time: higher interest rates, pulling money away, a stronger dollar, making it look pricier, and the smart money cashing out. And gold falls every single time this sequence plays out. Every single time. I want you to really hear that, because what I'm describing isn't some rare quirk. It's not an anomaly. This is the standard operating procedure of every major geopolitical shock for the last 50 years. And the people who lose money are the ones who don't know the script. Let me tell you a story. October 1973, OPEC, and that's the oil cartel. The countries that pump most of the world's oil decides to cut production and put an embargo on the United States. Oil prices go through the roof. And what does gold do? Initially, nothing much. In fact, it sort of wobbles. People are scared, sure. But the mechanics I just described kick in, money pours into safe havens, and gold gets pushed around. And then, and this is the part worth framing, gold starts to climb slowly at first. Then it doesn't stop. Over the following period, it went up an amount that would make your head spin if I told you. And the people who bought it when it was boring and sideways and everyone was saying the gold trade was over, they made generational money. The people who bought it at the headline peak when it was all over the news, a lot of them got hurt. Jump forward to 1979. Iranian Revolution, massive disruption to oil production, same sequence. Gold initially does very little and then goes on a run of nearly 90% over the next year. 1991, Gulf War, Iraq invades Kuwait, oil spikes, gold pops a bit but mostly just sits there while energy and defense stocks go crazy. And then what comes after? Gold grinds higher for years. After September 11th, 2001, I remember this vividly because I was managing money at the time and the phone did not stop ringing. Gold was at about $250 an ounce. By the time that decade was done, it was at $1,900. That's not a typo. From $250 to $1,900 over 10 years, starting from a moment when everyone was terrified and nobody wanted to be in gold because the world felt too unstable, and Russia invading Ukraine. In 2022, same story. Gold finally breaks through $2,000 for the first time ever. It took a crisis to push it there, but the people holding it before the crisis happened were the ones who won. Now I want you to notice something about all those examples. In every single case, the initial move in a crisis was confusing or disappointing to gold holders. It wasn't a clean moonshot. It was messy and uncomfortable. And that mess, that uncomfortable sideways on period, is almost always where the real opportunity is sitting. The guy who buys gold when it's boring, when there's nothing exciting happening, when the news has moved on to something else, that guy tends to do well. The guy who buys it when it's on every front page and feels urgent, that guy usually buys the top. I've done both, by the way. Done both. Okay, so now let's talk about what's actually happening right now in the current moment. Because the setup today has a few ingredients that I think are more significant than most people realize. First, the dollar amount of U.S. government debt. Back in 1973, when we had the first big oil shock I described, the total amount the U.S. government owed was about $500 billion. Today, it's closing in on $40 trillion. The interest payments alone, just the interest, not paying anything back, just the interest, run about $1 trillion a year. That's more than the entire U.S. defense budget. Think about that. More money goes to paying interest on old borrowing than goes to every soldier, every aircraft carrier, every fighter jet, every base, every missile. That is a structural problem that doesn't go away. And it's the kind of thing that historically has made gold a very interesting thing to own over the long haul. Second, and this one really caught my attention, central banks around the world have shifted from net sellers of gold to net buyers. For a long time, central banks were dumping gold, European ones especially. And the conventional wisdom was that gold was this relic, this old-fashioned thing your grandparents kept under the mattress while serious modern economies dealt in currencies and bonds. That story is changing. Countries in Asia especially have been buying gold in quantities we haven't seen in a long time. Poland, several others. There's been a quiet but meaningful shift in who's accumulating gold at the institutional level. And when the people with the biggest balance sheets in the world start quietly buying something, that tends to matter. Third, and this is the one I find most interesting right now as I'm watching prices, gold has fallen far enough below what's called its 200-day moving average to trigger a pattern that has historically been followed by significant recoveries. Now, a moving average sounds complicated, but it really isn't. Imagine you run a hot dog stand. You sell hot dogs every day, some days more, some days less. If you average out your last 200 days of sales, you get a pretty good sense of what normal looks like. If today's sales fall way below that average, something unusual is happening. Either there's a problem with your stand, or the weather was bad, or everyone went to that new taco truck. It's a flag, a signal to pay attention. The 200-day moving average in gold works the same way. It just tells you what normal looks like over a long stretch. And right now, gold is trading significantly below that line. And historically, the last 10 times that happened, on average over the following 12 months, gold recovered and then some. Not a guarantee, not even close to a guarantee, but a pattern worth understanding. Now here's where I have to be a little careful, because I don't want you to walk away from this video thinking, got it, gold always goes up after a crash, I'll just buy the dip. That's not the lesson. The lesson is about the sequence, and the sequence has 4 phases, and the timing of each phase matters. The first phase, we're probably in it right now or just coming out of it, is panic. Prices drop fast, the news is terrible, every headline is about the end of the world or the end of gold or both. Retail investors, regular people like me before I learned this stuff, lock in their losses because it feels like the smart thing to do. Sitting on a loss is painful. Our brains tell us to stop the pain. And so we sell, and usually we sell right near the bottom. I've done it. Most people have done it at least once. The second phase is what I call the exhausted middle. The panic settles a bit, prices kind of drift sideways or bob around, nothing exciting is happening. The news moves on to something else, and this is actually the most dangerous phase for regular investors because it feels like nothing is happening, which feels like an invitation to do something else with your money. This is also weirdly where a lot of the best entry points are found, not at the moment of maximum fear, but in the boring aftermath when nobody's paying attention anymore. The third phase is the quiet recovery. Big institutions start buying again, central banks are building their positions, the price starts to tick up slowly. And retail investors, again, people like me, and probably you are too, burned from the first 2 phases to participate. They got hurt, they got cautious, and now they're watching from the sidelines as the thing they sold starts to climb back. And the fourth phase is where it becomes a news story. Again, prices are at new highs, and the cycle starts over, with a new group of people buying at the top. The only way to break that cycle is to understand it. And now you do. So let me tell you what I'd personally be studying right now. Not what to buy. I'm not your financial advisor, and frankly, even if I were, I'd still tell you to think for yourself. But here's what's on my radar. The first thing I'd look at is the gold mining companies, not gold itself. And the reason for this is one of my favorite things about markets, which is leverage. Here's the simplest version of the idea. Let's say a mining company can pull an ounce of gold out of the ground for $1,400. If gold is trading at $3,500, that company is making over $2,000 of profit on every ounce. If gold goes up to $4,000, that same company is now making $2,600 per ounce. A 14% move in gold's price created a 30% move in that company's profit. That's leverage. Built in, no margin account required. When you buy a mining stock, you're not just buying exposure to gold, you're buying a leveraged bet on gold's price, amplified by the company's margins. That's why when gold has a big run, the really serious money often gets made in the miners, not in the metal itself. Now, of course, the foot works both ways, and a bad mining company with expensive operations or bad management can lose you money even when gold goes up, which is why you want to look at the ones with low costs, strong balance sheets, and management that hasn't spent the last decade over-promising. The second thing I'd study is the royalty companies. This is a business model that I think is genuinely elegant, which is not a word I use about many business models. A royalty company doesn't mine anything. They find a mining operation that needs capital to expand, they lend them money or buy a stake in the future production, and in exchange they get a royalty, meaning a percentage of everything that comes out of the ground, forever, without having to pay any of the operational costs. No workers to manage, no equipment that breaks down at the worst possible moment, no environmental headaches. They're like the landlord of a gold mine, collecting rent. While the miner does all the actual work, when gold prices go up, the royalty company's income goes up proportionally. When gold prices go down, they're still getting their cut. It's a quieter, steadier, slightly less exciting way to own exposure to gold, and quieter and steadier is usually underrated. The third thing, and this is the thing most people never think to look at, is the premiums being paid for physical gold in different markets around the world, particularly in China and parts of Asia. When Chinese buyers are paying significantly above the global gold price to get their hands on physical metal, that tells you something about genuine demand that doesn't show up in the futures market or the ETF price. It's the difference between what people will actually pay in the real world and what the paper price says. When those diverge significantly, the paper price usually catches up. It's like finding out your neighbor just sold their house for 30% above the listed price. The listing price is data, and the actual sale price is reality. I'd want to understand where those two numbers are right now. Let me bring it home with something that I think about a lot and that doesn't get talked about enough. Most people approach investing like they're at a casino. They want to pick the right number, get lucky, and walk out with a win. And the market is designed not intentionally, but structurally to encourage that mindset. Because the more you trade, the more fees and spreads and commissions get collected by people in the middle. What's actually worked historically for regular people who aren't doing this full time is something much more boring. It's understanding why things are cheap, being patient enough to wait for the moment when they're cheapest, and then being patient enough again to wait for the world to notice. That's it. That's basically the whole game. Warren Buffett has said versions of this 100 times. Peter Lynch, the original, not me though, I share his taste in sensible shoes, built one of the best track records in fund history by buying things that were boring and obvious when nobody else wanted them. Right now, gold and silver are boring. The people who bought at the highs are frustrated. The news has moved on to other anxieties. The pattern I described, the same sequence that is played out after every major oil shock in the last 50 years, suggests we're somewhere in the middle of it right now. Not at the beginning, not at the end, but in that uncomfortable middle where the people who know the rules are quietly building positions and the people who don't know the rules are either sitting on losses or have already sold. I'm not telling you what to do. I genuinely mean that. And not in the legal disclaimer way where someone says they're not giving you advice and then immediately gives you very specific advice. I mean it in the way that my old mentor meant it when he told me, Peter, I'll show you the map, but you have to decide whether to make the trip. The map, as I see it, looks like this. Gold and silver have dropped sharply during a geopolitical crisis, which is the exact normal thing they do before extended multi-year recoveries. The structural reasons for owning them, government debt that is enormous and growing, dollar debasement concerns, central bank buying, haven't gone away. They've gotten more pronounced. The technical setup, meaning where prices are relative to their long-term averages, looks more like an opportunity than a danger. And the sentiment, the way people feel about gold right now, is exactly the kind of fearful, frustrated, I knew it was a scam feeling that tends to show up near lows rather than near highs. What I'd encourage you to do is not make any fast moves in either direction. Don't panic sell what you have. If you own gold or silver, don't rush out and buy it all right now. Just because I explained a pattern that sounded compelling, the right thing is to learn the sequence, understand where you think we are in it, and then act deliberately and in small pieces as the picture becomes clearer. Dollar cost averaging, which just means buying a little at regular intervals instead of everything all at once, has saved more regular investors from themselves than any clever trading strategy I've ever seen. The hardest part of investing, I've found, isn't figuring out what's undervalued. It's being comfortable holding something while everyone around you is telling you you're wrong. Gold right now feels wrong to a lot of people. It felt wrong in October of 1973 too. It felt wrong in late 2001. History has a pretty clear opinion about how those stories ended. Make of that what you will. I'll see you next time.